Hi candidates, welcome to another session of Manifested Online Classes. We are still continuing the topic of group accounts. In this session, I want us to look on an illustration question regarding how to prepare a consolidated statement of comprehensive income, or basically a consolidated income statement. Remember, in our previous session, we have looked on how to prepare the same and also we discussed on the various consolidation adjustments which are necessary in preparing a consolidated income statement. So let's go through the illustration. We see what we are told and equally what was required. So we are told C Limited acquired 80% investment in S Limited on 1st of April 2023. The statement of profit or loss and other comprehensive income for two entities for the year which ended 31st of December 2023 are presented below. So we have the statement of profit or loss and other comprehensive income for the year which ended 31st of December 2023 for C Limited and S Limited. We have revenue, cost of sales, gross profit, distribution and administrative expenses, a profit before tax, income tax expense, profit for the year, other comprehensive income which include the gain on revaluation of a property, and then we have the total comprehensive income for the year. We have some additional information about you're told a goodwill of shillings 100,000 arose on acquisition, an impairment review conducted as at 31st of December 2023. That is, an impairment review was conducted on 31st of December 2023, and it was decided that a goodwill on acquisition of S was impaired by 10%. Number two, we are told that on 31st of December 2020, that is 31st of October 2023, S Limited sold goods to C for shillings 300,000. 2/3 of these goods remained in S Limited inventory at the year end. And then you're told S Limited charges a markup of 25% on the cost. And then number three, we are told assume the profit and other comprehensive income of S Limited accrued evenly over the year. Number four, we are told at the date of acquisition, the fair value of S Limited net asset approximated the carrying amount with an exception of plant whose fair value exceeded its carrying amount by 100,000. And then you're told the plant had a remaining useful life of 10 years. So what are we required? We're required to prepare a consolidated statement of profit or loss and other comprehensive income for the for C group for the year which ended 31st of December 2023. So basically, this is a question for group account whereby we are required to prepare a consolidated statement of profit or loss and other comprehensive income. Remember, what we said is that anytime you come across a question for group account, the first thing you need to do is basically to come up with a group structure that will help you to know which company is the parent, which company is the subsidiary, and also from there you can do various workings which will help you in terms of preparing what you're required to do. So therefore, the first thing we need to do here is to come up with a group structure which will be working number one. Working number one, we come up with a group structure. So where do we get that particular information? In the first paragraph, whereby we are told C Limited acquired 80% investment in the company which is called S Limited. On which date? On 1st of April 2023. So 1st of April 2023, this is what we refer to as the date of acquisition, the date of acquisition. So when preparing the consolidated income statement, it's very, very important for you to identify two dates: the date of acquisition, which we already have there, date of acquisition, which is the 1st of April 2023, and then you also need to have the date of consolidation. So when talk about the date of consolidation, this is the date you are required to prepare the consolidated a statement of profit or loss. If you go to the requirement, we're required to prepare our consolidated statement of a profit or loss on 31st December 2023. 31st of December 2023. So having identified those particular two dates, you then need to identify, or basically you need to check whether this particular subsidiary was acquired during the current financial year. So you can see the current financial year is ending on 31st of December 2023. It automatically means that that year started on 1st of January 2023. That is when the year started. But when was our subsidiary acquired? That is S. It was acquired on 1st of April 2023. These are some few months to the end of the year. So in other terms, we can say that this particular subsidiary was acquired during the current financial year. In fact, 9 months to the end of the year, because if you count from April to December, those should be 9 months, because here we don't have January, February, and March. So meaning that we have 9 months, and therefore take into account this particular subsidiary was acquired during the current financial year and actually 9 months to the end of the year. Then we have said in preparing a consolidated income statement, we only take into account the revenue and expenses of this subsidiary from the date it was acquired to the date of consolidation. We are going to take into account the revenue and expenses of S only for 9 months. Only for 9 months. Actually, we are going to note number 3, or the information in note number 3 is what is important. So therefore, this is our group structure. So from this group structure, we can say that C Limited, this will be the parent company, whereas this is a subsidiary, and therefore the company which is supposed to prepare the consolidated income statement is what is the parent, by adding similar items of revenue and expenses of the two companies. But also in this case, we have said in preparing this consolidated income statement, take into account as our subsidiary was acquired 9 months to the end of the year, we're only going to take into account its revenue and expenses only for 9 months. That is very, very important. Then let's go to the additional information. Before we prepare what is required, I think we need to do some few workings. In note number 1, you are told goodwill of shillings 100,000 arose from acquisition. So in this case, when preparing the consolidated income statement, we don't take into account the goodwill there, because goodwill, we know, is an asset. So what we take into account here is any impairment loss. And that's why you can see in the other sentence of note 1, you're told an impairment review conducted at the end of the year, or an impairment review was conducted at the end of the year, and it was decided that the goodwill on acquisition of S was 10% impaired. So the reason why we given that particular information is for us to be able to compute the impairment loss. Impairment loss on goodwill. Impairment loss on what? On goodwill, which would be equal to 10% of the impairment loss of the goodwill. So 10% of the value of the goodwill, which is 100,000, and this will be 10,000. And recall what you have said in our previous session, that this one is supposed to be included as part of administrative expenses. And then we go to note number 2, whereby we are told that on 31st of this October 2023, these are like 2 months to the end of the financial year, S Limited, which is now our subsidiary, sold some goods to C, which is the parent, for shillings 300,000. So what is that? So this is now what we refer to as intragroup trading. Intragroup trading, sales between the group members. And in this case, is also important to note that these were sales by our subsidiary, that is S Limited, to C. So the goods which were sold by our subsidiary, that is S Limited, to C, they had a value of 300,000, and also our figures which are given in the statement of profit or loss are in thousands of shillings. So when taking any figure from the additional information, also recall to omit the last 3 zeros. And in fact, this will also apply here. That figure, we're going to take it as 10,000. So this particular amount of intragroup trading, from what we have discussed in our previous session, this one we are going to deduct it from the group revenue. So once we add the revenue of the parent and the subsidiary, hi candidates, welcome to another session of manifested online classes. We are still continuing. Hi candidates, welcome to another session of manifested online classes. Hi candidates, welcome to another session of manifested online classes. We are still continuing with the topic of group accounts and in our previous session we have discussed on the various consolidation adjustments which are necessary in preparation of the consolidated statement of financial position, and specifically we talked about adjustment relating to amount of intercompany debt, which we said should be eliminated from group receivables and the group payables, that is whereby the amount of intercompany debt is the same. We also looked on the consolidation adjustment whereby the amount of intercompany debt is not the same, whereby we said the difference between the amount of intercompany debt basically is a cash in transit, and also we looked on how to deal with the same in preparing the consolidated statement of financial position. We also talked about adjustment to do with the fair value exercise, which we said is the revaluation of assets by the subsidiary company on the date of acquisition. And actually we say that once the subsidiary company revalue its asset on the date of acquisition, the subsidiary company do not account for that revaluation. As a result of that, in preparing the consolidated statement of financial position, we say that two adjustments are supposed to be made. The first one is called the revaluation adjustment, which we said is an adjustment relating to any revaluation gain or a loss. And also we talked about the other adjustment, that is depreciation adjustment. But also remember that this particular adjustment we said is only supposed to be done whereby the asset which was revalued is a depreciable asset. If the subsidiary company revalued an asset such as land which is not supposed to be depreciated, then we say that this particular adjustment is not necessary. So the only adjustment which is made in such a scenario is adjustment relating to revaluation gain or loss. So therefore, what I want us to look on an illustration whereby we have a question for group account, a question requiring the preparation of a consolidated statement of financial position, and we have these two adjustments. That is adjustment relating to intercompany debt and what we refer as a fair value adjustment. So let's go through the illustration and you see what we are told. And it's on 1st of January 2020 for shillings 720,000 when the retained earnings of H Limited was shillings 300,000. The statement of financial position of the two entities for the year which ended 31st of December 2023 are presented below. So what you're given there is the statement of financial position as at 31st of December 2023 for the two companies, that is B Limited and also H Limited. We have the non-current asset which include property, plant and equipment for the two companies. We also have the investment in the subsidiary. This is the amount of money which the parent company paid when acquiring 60% of the shares in the subsidiary. And then from there we have the current asset, we have the total asset, and then at the equity we have the share capital of the two companies, we have the retained earnings, and then we have the current liabilities and non-current liabilities. Then we have some additional information about you're told it is a group policy to value non-controlling interest at their proportionate share of the fair value of the net asset at the date of acquisition. So if you come across that particular information, basically that guide you in terms of knowing the method to be used in the computation of what? Of goodwill. So, and in this case, we are going to use the partial goodwill method, because we said that if you come across some information whereby you're told it is a group policy to value NCI at fair or full value, then in such a case you compute the goodwill using the full goodwill method. But if you come across such a statement that is a policy of the group to value NCI at their proportionate share of the fair value of the net asset, then when computing the goodwill you use the partial goodwill what method. Number 2, we are told included in the trade receivables of B Limited was 80 million due to H. In the books of H Limited, the amount due to B was shown as 60 million because H Limited had remitted shillings 20 million, and not 20 million, rather 20,000, but B Limited had not recorded the remittance. So this is adjustment relating to amount of intercompany debt. Number 3, we are told at the date of acquisition, the fair value of H Limited net asset approximated their carrying value, with an exception of plant, whose fair value exceeded its carrying amount by shillings 100,000. So the plant had a remaining useful life of 10 years at the date of H Limited what acquisition. Basically, that is adjustment relating to what we refer as a fair value exercise. So what are we required to do? We are required to prepare the consolidated statement of financial position for B Group as at 31st of December 2023. Remember what we said is that if you come across such a question for group account, the first thing you need to do is always to come up with a group structure, and then from there you consider the consolidation adjustment to be made in preparing the consolidated statement of financial position, and then from there you proceed, you combine, you add together similar items of asset and liabilities, those of the parent and those of the subsidiary. And also we have to compute two important items: the group retained earnings and also the non-controlling interest. So therefore the first thing we need to do here is basically to do some few workings, and the first working we need to have here is to come up with a group structure. We come up with the group structure. So what do we have information about the group structure in the first paragraph, whereby we are told that B Limited acquired 60% of the investment in H Limited on 1st of January 2020. So basically from this particular information now which we have here, this will be our parent company, whereas that will be the subsidiary. And also what is the percentage NCI here? The percentage NCI is 40%. The minority shareholders have an interest in the subsidiary equal to 40%. Then in the first paragraph there, I think we are also given the retained earnings of this company on the date of acquisition. We are going to use that in the computation of goodwill. Remember here we are computing the goodwill using the partial goodwill method. And actually we can compute the goodwill as a second item here. Goodwill on acquisition. Remember we are using the partial goodwill method. Partial goodwill method, and this is as per the information we are given in note number 1. That is a group policy to value non-controlling interest at the proportionate share of the fair value of the net assets. So here we need to have two columns, and basically our figures are in thousands of shillings. So under the partial goodwill method, always we start with the purchase consideration paid by the parent company. So the purchase considered current asset, whereby we are given the amount the parent company had invested in the subsidiary, and that is 720. So to this then acquired. So this one we are not given, and basically we say that from its statement of financial position, specifically in the equity section, so the share capital of the subsidiary is 500, and then to this we add any pre-acquisition the subsidiary company was having at the date of acquisition, including do not have any share premium. So we also take into account in paragraph 1, which is 300,000, and also you have to check whether this company revalued the asset on the date. which occurred on that as a result of the revaluation of asset by the subsidiary company on the date of acquisition, you also include it here. So, and as per the information which is given in note number 3, we are told at the date of acquisition, the fair value of H Limited is a subsidiary, net asset approximated their carrying value with an exception of a plant whose fair value exceeded the carrying amount. The fair value exceeded, treated as a pre-acquisition revaluation reserve. So we include it here. So this can 100, and then in our case, we are only interested with the net asset acquired by who? By the parent company in the subsidiary. So we take 60%. So and actually we are told that is the amount which was included in the receivables of this company. Automatically, the same amount should be included in the payables of the subsidiary. But you have said that may not be the case, whereby the amount of intercompany debt is not the same. So whereby, for example, this subsidiary had already sent a check. So of which now that will make the amount of intercompany debt not to be the same. So we are told in the books of account of H, which is now the subsidiary, the amount due to B, which is the parent, was shown as 60. So the amount included now in the payables of H Limited, in this case, is 60,000. So automatically in this case, you can see the amount of intercompany debt is not the same. So and automatically this difference of 20,000, this 20,000 transit, but there is some information which are given, and bank balance will be added to the group cash and bank balance. Cash and bank balance. So that's how we deal with the amount of intercompany debt, which is not the same. So I think in our case we are through with that particular point number 2. Let's move to point number 3. In point number 3, we are told at the date of acquisition, the fair value of H Limited is a subsidiary. A net asset approximated their carrying value assets, and you're told the fair value of that item of plant was more than carrying amount with 100 million, which automatically you have said is a revaluation gain, which was not accounted for. And then you're told the plant had a remaining useful life of 10 years at the date of acquisition. So number 1, we refer to that as a fair value exercise by our subsidiary, which is H Limited. So because H Limited did not account for that revaluation, we have said that there are 2 items which we need to account for, or which we need to adjust in our consolidated statement of financial position. The first one is the revaluation gain. Why revaluation gain? Is because we are told the fair value of that item exceeded the carrying amount with an amount of how much? 100,000, not million, 100,000. These are a revaluation gain. So this one, number 1, will be added to the group property, plant and equipment. And number 2, we treat it as a pre-acquisition revaluation reserve. Therefore, use it in the computation of goodwill. That's exactly what you have done there. So therefore, the only remaining adjustment is that when preparing our consolidated statement of financial position, we are going to add it to the group PP. Number 2, we need to make the other adjustment, and that is depreciation adjustment, whereby we need to compute the depreciation other charge. This is the depreciation other charge by the subsidiary company. The subsidiary company is the one which revalued the assets. So how do we compute this? You have to recall the formula. So I've said in our previous session, you take the revaluation gain, which we have there, divide that with the remaining useful life of the asset which was revalued, times the proportion of time, which will be the time difference between the date of acquisition and the date of consolidation. So the revaluation gain is 100. The remaining useful life in note number 3, we are told 10 years. Then proportion of time. Proportion of time is the time difference between the date of acquisition, which we have here, 1st January 2020, date of acquisition to the date of consolidation. Date of consolidation is the date we are required to prepare the consolidated statement of financial position. We have here, we have 2020, 2021, 2022, 2023. 2020, 2021, 2022, 2023. How many years do we have here? 1, 2, 3, 4. So therefore, you compute depreciation other charge for how many years? For 4 years. For 4 years. So this will give us 40,000. So this particular depreciation other charge by the subsidiary 1, we less it from the group PP. We less it from the group property, plant and equipment. Number 2, we are also going to less this from the retained earnings of the subsidiary. This company has overcharged depreciation for 4 years. As a result of that, retained what? It retained earnings. So I think those are the 2 key consolidation adjustments which prepare the consolidation. So we just need to have a single column here, and our figures are in consolidated statement of financial position by combining, by adding to, we have it here. So this particular devaluation gain, which was not accounted for by the subsidiary, we have said that this one should be added to the group PP. Companies, we have investment in the subsidiary. That investment in the subsidiary is the purchase consideration paid by the parent company in acquiring 60% shareholding in subsidiary. We don't include it here. What we include here is the goodwill arising from acquisition, which we have here. That is a figure of 180. A figure of 180. So and then from there we have, we will get the total. Then we purchase inventory, receivable, cash, and so on. So therefore, any adjustment affecting receivables, affecting cash, will have to be made to that figure 340 plus 1790. Then we also have some adjustment here. We have this amount of intercompany debt, the amount of 80, which you have said will be deducted from receivables. Receivables is part of the current asset, is part of this. So therefore, this 80, we less it here, minus 40 plus 20. That will give us 5070. And then let's get the total non-current asset. We have 4260 plus 180, which is now the goodwill, which will give us 4440. And then 10, and these are total assets. So then from there we proceed. Record equity. Equity is for share capital. We only record the share capital of the parent company. Record the parent. You can see the ordinary share capital of the subsidiary. We don't combine it with that of the parent, simply because you have used that here. Yes, so we only include the ordinary share capital of the parent, which is 1,000. And then from there we have something called the group retained earnings. This requires some working. So we also need to do working 5 for that. Then showing interest. This will be working 6. That will be working 6. And then from there we record liabilities. So for liabilities we start with the non-current. So for non-current we add that of the parent 350 plus that of the subsidiary 290. No adjustment for that. That will give us a total of 640. And then current liabilities. Current liabilities we take 1580 for the parent plus that of the subsidiary 1100. And then we have some adjustment for this relating to the amount of intercompany debt. Now, trade payables, we know is part of the current liabilities. And we said from the trade payables, from the group trade payables, we less what? We less now a figure of what? This figure here of 60. So let's note that here with the red pen so that you can see the adjustment we are making here. So that is a adjustment for intercompany debt, working 3 there. Yes. So I think we can get now those final figures, so that now we can then proceed and we compute the retained earnings and NCI. So for current liabilities, we have 1580 plus 1100 minus 60, and that will give us a figure of 2620. We will get the total equity and liabilities. So but we have two items here which we need to compute. So I think we can start by computing the group retained earnings. Group retained earnings. So how do we compute the group retained earnings? Recall what you have done, or basically what we say to compute the group retained earnings. We take 100% of the parent company retained earnings plus 60% of subsidiary post acquisition retained earnings. So we need to have that working here, whereby we need to have two columns for the parent B and for the subsidiary H. So what we do is that we take the retained earnings as given in the statement of financial position. For the parent is 3430. For the subsidiary is what? Is 1800. But now to this of the subsidiary, these include the pre-acquisition and post. Pre-acquisition, we know it because that is a figure we used here in the computation of goodwill. So what we are interested with and what we include here is only the post-acquisition, because this is a pre and post. So what we do, for us to get the post-acquisition, we come and we less the pre-acquisition. So at the date the subsidiary was acquired, it had a retained earnings of what? Of 300. So after deducting that, we will be left with post-acquisition retained earnings, 3430, and then we get 1500, and then we check whether there is any consolidation adjustment to be made to this particular earnings, to these retained earnings of either the parent, that of the subsidiary, from the workings which you have done. Number one, here we don't have any impairment loss. If there was any impairment loss, that should be deducted from the retained earnings of the parent, which we don't have. This amount of intercompany debt will not affect this, but we have these revaluation gain the same, but we have this depreciation what? Under charge. See what we said here, we less that from the retained earnings of this company. So we're going to less the depreciation under charge, and that is by the subsidiary of how much? Of 40. So here we have 3430. What about here? 1460. Is that correct? Let's confirm. 1500 minus 40, which will give us 1460, and then we get the group share of this. Group share of this is 100%, of this is 60%. 60% of this of 1460 is 876. Then what do? We add those two figures plus the 3430. That will give us 4306. That is now the group retained earnings. The group retained earnings 4306. So that is from working what? From working 5. I think we can just refer to that as working 5. Working 5. Finally, what we need to do is to compute these group retained earnings. Not the group retained earnings, rather the non-controlling interest. The non-controlling interest. So the non-controlling interest, you have to recall that this is the minority shareholders' share of the net asset in the subsidiary. In the subsidiary. So how do we compute that? That is NCI at the year end. NCI at year end. So we want to determine the net asset, or basically the minority shareholders' share of net asset in that particular what? Subsidiary. So our subsidiary is S. So what we do is that we take the net assets of that particular subsidiary at the, in this case, remember you said the net asset, this one will be equal to equity. Will be equal to equity, share capital plus reserves, or alternatively, you can just take asset minus liabilities. But majorly in group accounting, we compute the net asset to be equal to share capital and what? Reserves. Basically, this one we get it from the balance sheet, from the statement of financial position of the subsidiary at the equity section, and its net asset at the end of the year was 23, which we are saying is the same with equity, share capital and reserves. Then the number of adjustments which we need to make for as a revaluation reserve, it was supposed to be part of this. Hi candidates, welcome to another session of manifested online classes. We are still continuing the topic of group accounts, and so far we have been able to look on how to prepare the consolidated statement of financial position, and actually the various consolidation adjustments which are necessary and which you need to know specifically in preparing a consolidated statement of financial position, specifically whereby the parent company has invested in a subsidiary. So in this session, I want us to continue and look on how to prepare a consolidated income statement or a consolidated statement of a profit and loss, which is also known as the consolidated.
Hello and welcome. It's a pleasure to have you once again at the Manifested e-learning platform. We've been answering questions from the fixed income investment analysis paper that was done in December 2023. So far we've done question 1 up to question 4. In today's lesson, we're going to answer the last question. That is question number 5. Part A of this question reads, explain 2 types of municipal security structures. Explain 2 types of municipal security structures. Now, candidates, municipal security structures are debt securities that are used by the state and the local governments or their agencies to finance various public projects and operations. And there are several types of municipal security structures. Candidates were required to explain 2. There are many of them. We have, for example, the general obligation bonds, abbreviated as GO. There is the revenue bonds, the tax-exempt bonds. We have the taxable municipal bonds. We may have the bond anticipation notes, and so on. Those are 5. Candidates were to explain 2. So let's put down the 5 types of municipal security structures. Number 1, types of municipal security structures. The first one is the general obligation bonds. General obligation bonds. Now, these bonds are backed by the full faith, credit, and taxing power of the issuer. They are typically used to finance projects that benefit the entire community, such as schools, roads, public buildings, and so on. 2, revenue bonds. Revenue bonds are backed by the revenue generated by specific project or facility, such as toll roads, airports, water and sewer systems, or even public utilities. The repayment of these bonds relies on the project's ability to generate sufficient revenue. That is the revenue bonds. Tax-exempt bonds. We have the tax-exempt bonds. These bonds offer interest income that is exempt from any tax. All right. They can be either general obligation, cannot either be general obligation bonds or revenue bonds. Here, the interest is exempted from any form of tax. Tax-exempt bonds. Then we have the taxable municipal bonds. Taxable municipal bonds. Taxable municipal bonds do not offer tax-exempt status on the interest income. They are typically issued for projects that do not qualify for tax-exempt status, or by entities that have exceeded their tax-exempt borrowing limit. Taxable municipal bonds. We may also have the bond anticipation notes. Bond anticipation notes. These are short-term securities issued by the municipal to finance immediate projects costs.